And right now, everything's a derivative of oil, even interest rates, right? It's one of these short-term fluctuations where, yes, it's about growth and inflation, but it's not really about maybe the labor market so much as it is just about the price of oil, even though that price of oil impacts the labor market.
So joining me today, Mr. George Gammon. Now, George, you and I were both in St. Bart's last week for Hugh Henry's. And by the way, this is being recorded on August 11th, just to give everybody a sense of it. We were down in St. Bart's talking to a bunch of traders, wealthy individuals, and most of the conversation and questions were about the stock market, of course. Are we in an AI bubble? Is it going to crash? And other people wanted a big topic of conversation, interest rates. Are interest rates going to go up? Is the Fed going to hike? But I think you and I both agree that the story that actually bridges both of those, the stock market as well as interest rates, is the credit cycle, right? Because the credit cycle is kind of sitting in between. It has one foot in both camps. And there is a lot of really big stuff going on in the credit markets right now, from credit default swaps to, again, like I said, this is recorded on August 11th. So just yesterday, we heard from NVIDIA as well as six of the biggest firms on Wall Street who said, we're going to throw another $500 billion at this thing just to hope this thing that it actually gets to the end, to cross the goal line, because we're starting to see some tightness in the monetary system. So, George, we'll get to interest rates in the stock market, but let's start out with the credit cycle.
What's unbelievable to me when I read the details of that story that you're talking about with Jensen and NVIDIA and all of these, Larry Fink types that are coming to the table and say, oh, we'll put up, in fact, it was more than 500 billion. And first of all, the thing that gets the spidey senses going, as far as my inner skeptic, if you will, is they're calling it an MOU. Did you see that? I'm like, Are you kidding me? You're literally calling this a memorandum of understanding after how, the last MOU we got didn't really pan out that well. So I don't know if I'd use that.
The last several, right?
Yeah. I'm like, really? This is what you're naming it? It's just like, how obtuse can you possibly be? But then,
George, but doesn't that say that, they're getting a little, I don't want to say desperate. Desperate's probably too far, but like you said, the spidey senses are tingling because they're like, okay, if we got to come up with a lot of money, I suppose we will come up with a lot of money because we don't really have a whole lot of choice, but it's we don't have a whole lot of choice part.
Yes, that's correct. I think if you're NVIDIA, you understand that this, call it circular financing, is effectively a Ponzi scheme. And it's just like that scene in The Big Short. Like everyone remembers that with the Jenga puzzle. And it sounds, AI, you've got all these buzzwords and it kind of gets a little confusing. And demand is going parabolic. There's no disputing that. And there's no disputing that it's the future. But when you just kind of sit back and say, okay, well, what is actually going on here as far as the model, you realize that the whole thing, even NVIDIA, is really dependent on one Jenga piece. And that's basically the models for someone figuring out how to make an economic model of AI itself. And as of right now, as far as I can tell, their economic model is, let's just sell $20 bills for $10. And in that model, yes, demand will go parabolic. But at some point in time, you're going to have a big problem, right? Unless you can figure out how to sell that $20 bill for $21 or $25. And so that's that Jenga piece. So what they're doing, if your audience hasn't heard, is Jensen goes to the big banks and the big funds like Larry Fink, and he says, hey, I've got this great idea. All of my customers are running out of money. So can you just go ahead and extend them another 500 billion? And we're going to spin this as though it's a new asset class. I don't know if you read that, and they say, it's really more like commercial real estate. It's more like lending that's collateralized. So like in real estate, a lot of times you're not lending based on the borrower. You're really lending on the asset itself. And so Jensen's like, well, why don't you just lend using these GPUs as collateral? So it doesn't matter how garbage the borrower is. It doesn't matter if there's no chance they pay you back, because at the end of the day, you have this collateral, as if somehow they can foreclose on that and somehow they can sell it and make back their money. So then after I'm thinking all this through, I'm like, well, wait a minute. Even if these guys do this, as far as this lending, the credit of the borrowers, for the most part, is going to be so low, just like private credit, and we'll get to that in a second, that the interest rates would have to be astronomical. Even if you are using this as collateral, you're using something that depreciates basically down to zero within 3 years. So this is not like commercial real estate where you've got an office building that's going to be there for the next 50 years and you're still going to be able to rent it out, most likely at higher rates in nominal terms than you can get today. So it's all spin and it's all narrative. And then when you really kind of think through what they're actually doing, and I'd like to get your take on this, it's really just like, okay, we made a ton of money in private credit. And now we're not making any money in private credit, and that ship has sailed. So let's just do something else with a completely different narrative. But the nuts and bolts of it is still private credit, because the nuts and bolts of it is just these same Larry Fink private credit guys that have this black box where they won't tell you what's in it, and they won't admit that everything in it is basically worth 10 cents on the dollar. It is, oh, trust us, it's worth 99 cents on the dollar. So they're like, okay, we're getting no more investors now. So let's do something that's basically the exact same thing, but call it something completely different and completely innovative. And let's collateralize it with AI. So then they go right back to their investors, the pension funds, the insurance companies, et cetera, and say, hey, we have this brand new asset class. It's called collateralized AI or whatever they're calling it, right? And by the way, did you notice that NVIDIA's backing up 25% of it? So it's basically like they're co-signing or they're taking 25% of the risk onto their balance sheet, which in and of itself should tell you that this is doomed to fail, because the reason they're doing that is to get the interest rates down that these guys are willing to lend at. Well, why would they need to get the interest rates down? Because the people borrowing can't pay a market rate. Or there's no way that they can pay a market rate because their business sucks, because right now they have no way to actually make profit. So this is it's just another one of these Wall Street things that the Blackstones, the BlackRocks, the KKRs, the Apollos, they do this all the time, where they find something where they can just milk the average investor or pension fund, let's say, for fees. And they have really no downside risk because it's not their money, but they have all this upside. So it's like a free call option, except they're collecting fees on that free call option. And then once that goes sour, then they've got to think of something else. And instead of actually being innovative, they just take the exact same thing that sucks and just put a new spin on it and get the exact same investors. They basically dupe them into this new Ponzi scheme. And I just can't believe that the people at CNBC, because that's who interviewed Jensen yesterday. Yeah, I can't believe they're not calling him out on this. It's just like one of those Fed meetings that you see with Wersch, where, Steve Leisman always gets asked the first question. And I don't want to be too hard on him because it's everyone in that room. But I'm sure you do this. When you're sitting there listening to these questions live, you're just pounding your head on the table and you're like, why don't they ask him some legitimate questions? Why don't they ask him some tough questions that are totally, completely obvious? And it's the exact same thing with holding Jensen's feet to the fire with this new, I don't even know what you want to call it, with this new narrative to dupe.
George, it's branding, right? That's what it comes down to. It's branding. And you're right. That's exactly it. CNBC won't ask Jensen the questions, but the market is asking the questions. And that's why they're scrambling on Wall Street. I think desperation is a little too strong of a term, but it may not be that strong of a term, because when I heard that announcement, what I heard was, oh crap, we can't sell our bonds. We can't finance these deals. We got to start doing something to rebrand the debt here, so that, because we're getting way too much pushback, way too many questions that we don't have the answers to. So how do we not just shift the narrative, but actually shift the structure a little bit to make it sound like there's something
marketing
substantial?
How do we change the marketing? And just to be clear, both sides need it. So Jensen needs it because he's got to feed the beast, so to speak. And by the way, he's got to feed the beast from all these companies that don't make a profit. So how the hell do you do that, right? And the hyperscalers, they're going cash flow negative. So they've got to issue debt, but those interest rates are going up to a point where it might not be cost effective, or it might not warrant the risk reward. And then you've got all the private credit guys that need another marketing spin to collect more fees because this thing over here is completely falling apart. What really pisses me off, I don't want to beat a dead horse, but it's just they're taking the thing that's falling apart, and instead of acknowledging that, hey, this was kind of a bad idea, just this subprime lending, and now, the tide is going out, we're having to pay the fiddler, and unfortunately it's our investors that are doing that. They're knowingly taking something that where the risk or the probability of it panning out is like 1%. It might even be 0%. And then they're trying to sell that as the next hot thing, or like, this is the risk-free return. And it's just like, where are your ethics, man? And how are people not calling them out on this? Because at the end of the day, it's the retail investor that's going to get burned, even if it is through a pension fund. Okay, great. Well, then the firefighters get burned. The teachers get burned. The people that have their money, or where the pension fund, they owe money in the future to these individuals, they're just normal people. Larry Fink doesn't have his money with a pension fund. I can assure you that. He's the guy that's robbing them blind.
From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones, where we're going to spend 4 days asking the questions that truly matter. What happens next? Where are the biggest risks being mispriced? Where are the opportunities? What should change our minds? And how should we think about positioning around it? This is not a conference built around speeches. It's a small room built around discussion, some disagreement, and actionable advice. So if you manage some meaningful capital, or you're seriously interested in all of these questions and finding answers to them in a very small, intimate setting, apply below.